Okay, here we are. We are ready to do absorption costing versus variable costing. Absorption costing is what we've been doing with GAAP. It's used by outside investors, has the gross margin, includes the cost in the cost of goods sold as direct materials, direct labor, variable and fixed overhead. Now we're going to turn and look at variable costing for internal use. And it's only going to have direct materials, direct labor, and variable overhead in the cost of manufacturing. So this fixed cost becomes a period cost. So let me explain this as we go on. Here we're going to compute the production cost under absorption costing. And, we've done this over and over again. We've got direct materials. We've got labor, we have variable overhead, and we have fixed overhead, which is determined by how many units we made divided into the amount of money that the fixed overhead came to. So if we add those all up, this comes to $8 per unit. We find that the unit cost is $48. That's using our traditional way that we typically calculate using absorption costing. Now, variable costing is a little bit different because remember, I only am going to use variable costs, which are going to materials, labor, overhead, variable overhead. So the unit under variable costing is only going to cost $40 a unit. And the thinking behind that is because this fixed cost is going to be there whether we manufacture or not. So we kind of take out that fixed cost and are only looking at variables. Now, if we move on and look at a variable income statement, and let's move this out of the way just so you can see it all at once. So the information is at the top. We sold 4,900. We had variable costs of $25 a unit, and we had variable selling costs. Remember, we're going to look at those and put those in the upper part of this income statement now. So our sales are $441,000, which is 49 times 90. 4,900 times 90. Our variable costs are 4,900 times 25. Comes to manufacturing margin. If I subtract 122,500 from the sales of 318,500, and then we're going to take out the variable cost to get a contribution margin, and that's going to be 4,900 times 2. Now we're going to take the fixed costs out. These are actually in the location of where the period costs would be. So we have fixed selling and administration of $65,200, and we have fixed overhead of $78,000. Gives us total fixed of $143,200. This gives us a net income under variable of $165,500. Let's look at that very same thing under absorption. That's going to be different because remember, what have I done? I'm only putting production costs up here. It doesn't matter whether it's variable or fixed. They're coming up at the top under the cost of goods sold. So sales are the same, but now I have the variable costs, but I also have taken the fixed costs, which were $78,000, and found out that I produced 6,000. So that comes to $13 per unit. If I divide 78,000 by 6,000, it costs $13 per unit for fixed cost. How many did I sell? 49 times 13. So my fixed costs are now $63,700. So again, I can do my cost of goods sold. I can do my gross margin. I can come down here and use my period costs, which are the selling administration, get total fixed costs down here. Total fixed, or I guess this really should be called period costs rather than fixed. Kind of confusing. And I now have a net income of $179,800. Now there's a little bit of a difference here. Variable says my net income is $165. This one says my net income is $179. What is the difference? Well, the difference is $14,300. But if you remember, in the variable, I took out the full amount of the factory overhead in the period cost. Here, I'm only taking out $63,700 as up in the cost of goods sold. So the difference between 78 and 63.7 is 14,300, which is the difference between our net incomes. So it's the fixed factory overhead that makes the difference here. So let's look at this one and see what we've got. Now this one we're looking at we sold 20,000, we made 20,000. And we're going to make this into an absorption costed, which means we're going to have, and we're going to do it a little bit differently. Now we're going to look at for the gross margin. And first of all, I'm simply going to figure out how much this unit cost, okay? So under absorption, I've got the materials, the labor, the variable overhead, and the fixed, which is 65,200 divided by what we produced, 20,000. That gives us a $2 per unit cost, and our cost of goods sold is $27. If I multiply that times the unit sold, I found out my cost of goods sold is $540,000. And if I want to do a really quick income statement, I then find I had sales of $1.2 million, I had cost of goods sold of $540,000, and a gross margin of $660,000. Fairly straightforward. Now let's do a comparison here. We do the same thing that we had. So you see the 660. This is all the same. We've got that $27 per unit. But now it says, what happens if I double production, but I keep my sales the same? Same scenario. So the only thing that changes is this factory overhead per unit. The first time I had 20,000, so it was a $2 per unit. Now I have 40,000 and 40,000, so it's $1 per unit. Now remember, you're under absorption costing here. I've made more units, but my cost of goods sold has actually gone down. So my gross margin has gone up, 540,000 versus 20,000. So it gives you some uncertainty when you're looking at some of this stuff. And that's why you end up looking at variable costing so that you can stabilize that. This one, we are looking at a contribution margin under variable costing. And let's see what we've got going. We have sales of $20,000, $60. We have manufacturing of, we sold 20,000, right? And we had 12, 3, and 10. Those were our variable costs here. And that comes to 25, so that's $500,000. And then I have my variable selling and administration, 20,000 at 2. So I have a total variable of 540 and a contribution margin of 600,000. You could put a manufacturing margin in this line if you wanted to. And this, what are we going to do with this? I'm going to take this variable statement and turn it into an absorption statement. And it's really pretty easy to do. I just got to separate things out. So my sales are 300,000. My variable costs are 1.4. I think that was already defined for us. My factory overhead is a little bit different though. So my fixed factory overhead up here is 320,000. Well, we made 80,000. So the per unit cost for the fixed is $4. And that's going to be times 50,000 that we sold. So that fixed cost is 200,000 instead of 300,000 from up here. That gives me a cost of goods sold of 1.6 million and a gross margin of 1.4. Here's my selling. Here's my variable selling. And here's my total. I don't know why I've got that there. Should be period. Sorry, guys. $410, and I have a net income of $990. In the other one up here, you had $870. Okay, your difference is $120. If I compare my fixed factory overhead to my fixed factory overhead here, that's a $120 difference, which is the difference between the net income. Finally, how do you use this stuff? Here we're using absorption costing, and we're trying to find a target price, which is spelled wrong. So under absorption costing, so what do we got? I have a $50 variable, I have a 12, I have a 16, I have a fixed overhead of $2, and they actually gave that to me. So if I add those up, I have a total production cost of $70. I want to mark up 40%. So 40 times 70 is 28, and I have a target price of $98. And that's how we'd use some of this stuff. This is kind of just giving you an overview. We're going to do a lot more when we get into the homework. Thank you.